Welcome to the Deep Dive. Today we're digging into the Onity Group. Just had their Q3 2025 earnings call.
And look, there was a lot to unpack. We've gone through it, and the mission here is to really pull out the key signals for you.
Right. We're looking at the strategy, the forward guidance, and where they're really building an advantage.
Exactly. And the tone for management was, well, it was high confidence. They're talking strong execution, market outperformance. Our job is to see if the numbers back that up.
Okay, so let's jump right into the headline numbers. First up, adjusted pre-tax income, or PTI, came in at $31 million.
And that's their 12th straight positive quarter. I mean, that alone tells you something about the model.
Right, that stability. But the real stunner, the number that really jumps off the page, was the return on equity.
The ROE, yeah. It hit an annualized 25%.
Wow.
Yeah. Just to be clear, that's not just a small beat. That completely blew their own guidance out of the water.
And that kind of performance, it has to show up on the balance sheet.
It did. Book value is up to $62 a share. That's a solid 5% increase from last year.
So management is basically telling the market they're going to beat their full-year guidance of 16 to 18% ROE.
Oh, they're not just telling them, they're screaming it. And what's interesting is how they got there. Revenue growth was double digits, both sequentially and year over year.
And that came from both sides of the house, right? Servicing and originations.
Exactly, which is the whole point of their balanced model. It's designed to make money whether rates are going up or down.
The classic mortgage hedge. High rates are good for servicing, low rates spark originations.
And for both to be growing by double digits, it means they're really executing on both fronts at the same time.
All right, so let's dig into that because the originations side had what you called a breakout quarter.
It was a record quarter for them. Funding levels were up 39% year over year.
Okay, but let's add the crucial context here. The overall mortgage market it's not what it was in 2021.
Not even close. Management's own number is that the market's only 41% of that peak size.
So this isn't just riding a wave. This is aggressively taking market share from competitors.
That's the only way to interpret it. They pointed to two things. One, consumer direct really took off as rates dipped a bit in the quarter.
Makes sense.
And two, their B2B channel, especially their JDM or joint dealer management mix, also performed really well.
Okay, but let's talk about the real secret sauce here, the thing that turbocharges their returns. You called it the Recapture engine.
I did. And we need to break this down because it's so important.
So for anyone not deep in the weeds, what exactly are we talking about here?
Okay, so when you have a mortgage servicing, right, an MSR, and that customer refinances with someone else, that MSR just vanishes. It's called runoff.
A total loss of an asset.
Total loss.
Right.
The Recapture engine is their system for stopping that, for getting that borrower to refinance with them instead, so they keep the customer and originate a new profitable loan.
It turns a defensive move into an offensive one, so how good are they at it?
They're exceptionally good. Their funded volume from this platform was 1.8 times what it was last year in a pretty similar rate environment.
That's incredible efficiency.
But here's the metric, the one number that defines their competitive moat. For loans they originally sourced from their own consumer direct channel, their refinance recapture rate is 85%.
85. Let's just pause on that. That sounds unbelievably high.
It is unbelievably high. I mean, most of their peers would be thrilled with 40, maybe 50%. Hitting 85% means they've built a retention machine. It's a massive operational hedge against MSR runoff.
And they're still investing in tech to improve it. If they could push the rate on their whole portfolio closer to that number.
The whole valuation story changes. It creates a kind of earnings stability that almost no one else in the space has.
All right, let's flip to the other side of the model then, servicing.
Servicing was the steady contributor, as you'd expect. It also posted $31 million in adjusted PTI, so a perfect balance.
And they grew their own MSR portfolio.
They did, which feeds right back into that recapture strategy. More owned MSRs means more future opportunities.
But there was some pressure there, right? Something about prepaid speeds.
Yeah, a little bit. So even though the average loan balance, the UPB, went up, which is good for revenue, that was offset by higher runoff. Loans were paying off faster.
Okay, so a higher prepaid speed is normally a negative for a servicer. But given what we just talked about, is it fair to assume a lot of that runoff was just their own recapture engine at work?
That is precisely the argument management made. Any drag from runoff in servicing was more than made up for by the boom in profitable originations. It's the balanced model working exactly as designed.
That balance really seems to be the core of their strategy, and it looks like they're doubling down on the servicing growth pipeline.
The pipeline it's huge. They've signed 9 new subservicing clients already this year. They've got another 6 in negotiation.
What does that translate to in dollar terms?
They're expecting $32 billion in new subservicing in the second half of this year alone. That's 2.5 times what they did in the first half.
But the really interesting part, the strategic pivot, is where that growth is coming from.
Absolutely. They're not just chasing any volume. They're deliberately targeting the high-margin, small-balance commercial segment.
And that's a more complex business to be in.
Way more complex. Different collateral, different legal structures, but the returns are substantially better. UPB in that segment is up 32% year over year. It's a very intentional move up the value chain.
Okay, so that brings us to the big announcement. The exit from the Rhythm subservicing portfolio. Management is calling this a non-event. Is that just spin?
No, the numbers completely back it up. You have to understand what Rhythm is. It's a legacy portfolio. It's old, low-balance, pre-2008 subprime loans.
Sounds expensive to service.
Extremely. It was a drain. It was less than 5% of total revenue, and here's the kicker. After you allocate corporate costs, it actually lost money the last 2 quarters.
So they're ditching an unprofitable business line.
And replacing it with the commercial subservicing that generates a multiple of the profit per dollar. It's just smart portfolio management, a textbook cleanup.
All right, let's talk guidance. They actually trimmed their full-year UPB growth guidance down from 10+% to a 5 to 10% range. Now, normally a guidance cut is a red flag.
It is, but they spun it. And frankly, the argument holds water.
What's the argument?
That it's about quality over quantity. Because they're focusing on higher margin areas like that commercial business, they don't need as much total UPB to hit the same profit targets.
So less volume, but more profitable volume.
Precisely. It signals efficient capital deployment, not a business slowdown.
Okay, now for the tricky accounting piece. The deferred tax asset, the DTA, there was a $4 million tax provision. Can you break this down for us?
I'll try. So the DTA is basically a future tax saving. For years, they had a valuation allowance, a VA, against it because you weren't sure they'd be profitable enough to ever use it.
But now they're so confident in future profits that they're going to release that VA at the end of the year.
Exactly. And that release is a huge positive signal. But it does 2 things. One, it adds a big non-cash gain to their equity.
Which is good.
It is good, but it also increases the denominator in the ROE calculation. So they have to earn more dollars just to post the same ROE percentage next year. It's a high-quality problem to have.
Got it. And the second thing?
Their tax rate normalizes. It'll go to a standard corporate rate. They'll actually be paying cash taxes like a normal, profitable company. It's a sign of maturation.
So with all that going on, are they changing their MSR hedging strategy?
Management was very clear. No. The strategy is working well. It's focused on protecting GAAP net income, book equity, and managing margin calls. That doesn't change.
Okay, excellent. Before we get to our trade idea, we have to touch on technology. They call it their 4x4 approach.
Yeah, and this is where they're building that long-term moat. It's 4 tech categories: AI, robotics, NLP, and machine learning, aimed at 4 business outcomes.
So in plain English, what are they actually doing?
They're using robotics for repetitive tasks, reducing errors. They're using large language models, LLMs, to process loan documents and help with customer service.
And I'm guessing machine learning is the powerhouse behind that 85% recapture rate we talked about.
Absolutely. The algorithms are figuring out in real time who is likely to refi and when is the perfect time to reach out to them. It's all data informed.
And the 4 outcomes are cost leadership, revenue growth, customer retention, and superior operations. It all connects.
It all connects. And it's why the CEO feels they should be valued more like a tech-forward finance company and less like a generic mortgage servicer.
Which brings us to the segment we call the not financial advice pitch. Quick reminder, this is highly speculative. Please do not run out and do this.
Agreed. But based on everything we've heard, a specific paired trade starts to look pretty compelling.
All right, lay it on us. What's the pitch?
The pitch is this. Go long Onity Group common stock, and at the same time, go short a publicly traded peer that is basically a pure play agency servicer with weak or no recapture ability.
So the rationale is you're betting on Onity's strategy.
You're betting on the pivot. They are actively getting rid of low-margin, high-cost assets like Rhythm and plowing capital into high-return, scalable businesses like commercial subservicing and that killer Recapture platform.
And that 85% recapture rate is the key differentiator. It's an operational hedge that a pure servicer just doesn't have.
Exactly. It creates a stability in their earnings that others can't match. Management basically feels they're a premium company trading at a pure valuation or even a discount.
So the idea is that as they keep executing, that valuation gap is going to close.
That's the thesis.
Yeah.
It should lead to multiple expansion and what the CEO himself called significant upside for the stock, especially relative to that lower margin peer who is just stuck in one part of the cycle.
So to sum it all up, a balanced model that is absolutely firing, record originations, crushed ROE guidance, and very clear strategic shift to higher margin tech-enabled businesses.
Which leaves one big question for you to think about. What is the real premium value of a platform that can retain 85% of its customers in an industry defined by rate volatility? Does that kind of moat deserve a premium valuation? The market is just starting to figure that out.
Something to definitely keep an eye on. Thank you for joining us for this deep dive into Onity's Q3 2025 earnings. We'll get you on the next one.